and service, you also have to have operations to be able to produce it. So,
Give me 1 minute. This
Okay.
is new for me, folks, so give me 1 minute.
so a little bit about myself. Yes, I am an accountant. I've been in accounting for a couple of years. I actually owned a franchise in Los Angeles. I'm originally from Los Angeles. And I actually owned a franchise called Paget Business Services. And that's where I got started working with small businesses. I've been in corporate accounting as well, but my passion has always been in small business. The only reason why it's always been in small business is because I grew up in a small business. I grew up, my dad owned a building materials called Liberty Building Materials. I was just having a conversation about what I used to do with your Liberty Building Materials, and I could tell you how to build a wall now. Growing up, I can actually tell you what kind of plugs and things you need for your pipes and all that stuff. And so just knowing how to build a business and working in a small business my whole entire life has been very got a lot of skill sets. Work ethic, right? Take your kid to work was always the thing. Like that was our babysitting. I would go to work with my dad. I would also go to work with my dad. I would ride around with him, and then I have to go to work, and that's how I got paid. So I started working at 4. When I was 4 years old, working in the business, and we owned the business until I think the early 2000s. So like I said, it was in Los Angeles, and during the 92 uprising, our business was one of the businesses that survived in that area. We were in South Central Los Angeles, and because we were a business in the community, help the community, and a Black-owned business, our business was not attacked within that thing. So that tells you about being a great business owner and helping your community as well. Okay, so let's get into the numbers. All right, so let me go back a little bit. I just have a question for you. What's one money habit that you want to improve in your business?
I don't immediately jot down or put my expenses in as I go. And it catches up with me and it's a pain. If I did it as I went, it would be so much easier.
Okay. Do you use a system?
I do. I need to improve my system, but I do have a system.
Okay.
Yes.
Anyone else?
We're having to, for the lack of better phrasing, rob Peter to pay Paul.
Okay. We'll talk about that.
Yeah.
All righty. Anybody else? Okay. So let's talk about this. We're going to do a little bit of overview of all of the financial statements, the balance sheet, income statement, and then we're going to spend a little bit more time on cash flow, because that's kind of where, that's one of the most important financial statements, but one that's kind of more overlooked. And then we'll kind of make this a little bit more conversational on different ways. I'll tell you a lot of stories that I have working with different entrepreneurs, but mainly I have a sister that owns a catering company, and she's been in business for years. She's a great caterer in Los Angeles. However, she's my test client, and I'm the youngest of all 4 siblings, so she always doesn't really want to listen to me because I'm the baby sister, but very interesting. When I say she has a great business, it's really great if she would just do a few things, right, to make it a little bit better and improve it. So we already talked about me. And so, like I said, we're going to do a little bit overview of the financial statements, income statement, balance sheet, and cash flow statement. And then we'll show about how they're all interconnected. And then we'll take a deeper dive in cash flow statement. So the income statement, what does that show? It shows your sales, your revenue, and then it's minus your expenses over a specific time period. So it could be, all right, so it's over a specific time period. It could be monthly. You could look at it on a monthly basis. You could look at it on a quarterly basis, or you could look at it annually. So it's in a specific time frame. The result, hopefully net income, or it also will tell you that you have a net loss. So what are the key components of the income statement? Your revenue, your sales, or your service income? Your cost of goods sold is what does it cost to you to make those units, right? So it's that, what does it cost to you? What is the cost of the goods that you're selling or the service that you're providing? So if it's service, it will be labor costs. If it's a product, it's what is it that costs to make that product, right? So then you have a gross profit. So after that, that's like your gross profit. That's what you're making directly from those sales, right? And then after that is operating expenses, your rent, your salaries, your marketing. And then from there, and when we talk about operating expenses, they could be fixed or they could be variable. We won't go into that until we take a deeper dive in the income statement, but we'll see it again when we talk about cash flow. Then you have a net profit or you have a net loss. So why does it matter? It matters because it tells you how profitable your business is. It also shows where you can be overspending within your business as well. As business owners and newly business owners, we tend to kind of like, like if we do get revenue and we like get a big sale, they're like, okay, we want to buy the things that we need to buy. Do we necessarily need to buy it when we want it? Or do we need to let's look at our profitability? So that's kind of what your cash flow statement is gonna tell you. So income statement. Then the next one is, we have a little sample of an income statement right here. So you have your revenue of $120,000 minus your expenses. And then you have your net profit. So let's talk a little bit. Any questions about the income statement before we move on to the balance sheet? No?
Is this a new language for some of you?
A little bit?
Okay.
Okay.
I do have a question, but I'm going to save it. I think you're probably gonna cover it a little bit later. so,
Okay.
Yeah.
Okay.
Thanks.
So balance sheet. The balance sheet, it's a snapshot of what your business owes and what it owns. It also shows your assets, your liabilities, and equity. So the key formula, if you're in business or just an accountant, this is what you remember. Assets equals liabilities plus ownership. It's kind of the health of your business. So the key sections is broken down between assets, which is cash, equipment, receivables, anything that you own. Liabilities are your loans, credit cards, or any type of payables. And then equity is your owner's capital, what you have put into the business and what you have retained. And why does it matter? The balance sheet tells you how healthy and stable your business really is. And then it helps lenders. It helps investors assess are you a healthy business? Can I invest in it? Do you have a lot of liabilities that are going to encumbrance in your business? So, getting all these different loans and credit cards, is that a healthy thing? Does it show that your business is healthy and sustainable? And that's what the balance sheet is for. Any questions about balance sheet? Okay. And then here's a sample balance sheet. You start with, your assets, which is cash. You have accounts receivable, any type of equipment that you own, any type of inventory that you have as an asset. So your total assets is $28,000. Then you have liabilities. You have your accounts receivables. You have any type of business loan. Total liabilities is $10,000. And you invested your own capital of $18,000. So total liabilities equal $28,000, and you always want to have a balanced balance sheet. In this balance sheet, just top of your head, does this look like a healthy business? Would you consider this a healthy business, and why?
You have a significant amount of equity,
Mhm.
or in the, you're in the green here, not the red, by a significant margin.
Mhm. Anyone else? You're absolutely right. Because right here, you're looking at $10,000, your total liabilities. If you look at this balance sheet, your total liabilities is more than is less than the cash you actually have in the bank. So you have more cash that you have in the bank. You don't own a lot you don't have a lot of liabilities. And you have a $10,000 investment of what your net worth is in your company. So yeah, I would consider this a healthy business, a healthy balance sheet. All right, so cash flow. Track this, what does it shows? It tracks how cash actually moves in and out of your business. And it's divided into 3 different sections. One is your operating activities. So that's the day-to-day income expenses. That's what's in your income statement. That's how it's connected. And then investment activities is equipment purchases like assets or sales. So like if you buy equipment, that's part of the investment activity. That's how it's connected to the balance sheet. And then finance activities is the loans, repayments, or your owner's investments, grants that you get. Those are kind of all the finance activities. That's connected to your balance sheet and it's also connected to your cash flow statement. So those are how they're interconnected. And so why does it matter? Even really good businesses, sometimes they don't manage their cash properly. And so cash flow statements, they help you find those shortages and kind of find those different surpluses that are also there. So here's kind of an example of a cash flow statement. You have, for this coffee shop, you have cash received from sales. And then you have cash paid from expenses. And then you have your net cash flow from operating, which is $45,000. You purchased equipment, that's from investing activities because that was an equipment purchase. And then financing activity, received a loan of $10,000. You paid your loan of $10,000. So you have net cash from financing activities. So the net cash that you have that increased was $43,000 just for that month. All right, so like I said, how are they connected? Net income is connected to the income statement flows through the section of the balance sheet. So at the end of the section of the balance sheet, under equity, it'll say net income, right? So that's how it rolls into the balance sheet. And then the balance sheet also is that starting cash flow for your cash flow. When we say cash, what's cash in your bank? When you look at a balance sheet, the cash is the cash in your bank, and that's the starting point for your cash flow under operating. And then assets and liabilities, those are the changes in your balance sheet, like receivables and payables and inventory, and that explains the cash movement. So if you purchase equipment and investing, then your cash is going to go down, right? When you have receivables and people pay their bills, you get more cash goes up. So, and then equity and retained earnings, that's the net profit and loss each year. And it affects your retained earnings, which is part of the equity on the balance sheet. So, for example, your profit and loss, when I said the net income, when you have that net income, it goes into the equity section of your balance sheet. So they're all interconnected with each other. But one of the most the cash flow statement, that is kind of the one that most people overlook, right? Banks don't overlook your cash flow statement. They want to see it because it's the ins and outs of the inflows and outflows of what is really going on in the business, right? I used to work when I was in corporate America. I used to work and I was in Los Angeles, so I worked for a record company for a couple of years, and we had you guys know who Master P is? Right now, who Master P is? He was a rapper. Okay, so he was on our record label at one point in time, and it's called Interscope Records. Now they moved in there. They were under. It's called Interscope Records. It was I guess a record label for many rap artists and stuff like that. And so I managed his cash flow statement, and I had to manage it every single day. It wasn't a day that I did every morning. I had to go in. That was my job, to manage how much cash we had in his account. And the reason was because it was always like taking money going in, money going out. And so we had to make sure that he had enough cash in his account. So every morning I had to do a reconciliation of his cash account every day. I'm not saying you have to do that, but you see how important it is to be able to understand the inflows and outflows of what cash really is. So that's just in one, I mean, that's in a corporate setting, but it still works in the same way in your business, right? You want to be able to understand the inflows and outflows. You want to understand the different sections of it. So we're going to walk through an example, but if you understand it, think about it as water. You have your water filling up a tank, that's cash, right? You're filling up this tank of cash, that's money coming into your business, cash flow, water going out, and that's money being spent. If you drain faster, if the water comes out, then more water coming in, that's gonna happen? You're gonna have a problem, right? Because you're not gonna have any more money left. The same thing, you're not gonna have, if you drain faster than you fill it up, you're gonna run out of money and have a cash flow problem. And we'll talk a little bit about more than how that can easily happen, and you don't even recognize that it's happening. We'll talk a little bit about that, but let's talk a little bit about what counts as cash. So there's ways money enter your business from sales, right? Revenue, sales, services, all that. Customer payments. So like if you're a company that does like payment on time, or you have a receivable or anything like that, most businesses that are transactional, like, you pay for you pay for a product, I give you a product and it's transactional, then really your cash is cash. But then you may be a service business where you have a retainer and they pay over time. That's kind of accounts receivable. So customer payments, even from past sales. And then if you receive loans, you receive a loan from for a business, that's cash coming in. And then also grants. So like say you do a pitch contest and you happen to win $50,000 in the pitch contest. That's grants as well. Or you have someone invest in your business. That's also cash flow coming in. And then you contribute your own money to the business. Those are the different inflows of a cash flow statement. Any questions on how money comes in? You guys good?
I think there was one online.
Okay.
I don't know if they want to ask it now.
We do have one online. It's from Michelle Holloway, and she wanted to know the difference between accrual versus cash if you're looking at the statement. And then she had a follow-up question about how you build in a repayment plan if the owner's capital is technically a loan. Does that go as an operational expense? And Michelle, if I didn't ask those correctly, please feel free to unmute yourself.
Okay, so when we talked about customer payments, even if it's from past sales, that's how you create accrual. Because when we talk about accrual basis for accounting, we're saying that I'm going to recognize the sale when it happens, not necessarily when I collect the money. So that's kind of how that's how you create an accrual. So for example, I'll use my sister's party. It's a party. So she has say she has a event to do, and they pay her up front, and they'll pay her half, right, for the party, right? So they'll pay her half for the party, give her a deposit of $2,000 or $3,000 for the party. She performs the party, and it's a $10,000 party, but they've given her $5,000. And she says, so she does the party in January, right? So she does a Christmas party, it's a Christmas party. So let's say it's a Christmas party. She does a Christmas party in December. In December, she says, I sold my party, that party was $10,000. So she'll recognize that sale of $10,000 of revenue, right? But she doesn't get paid till January. That's the cash that's coming in. Even though her income statement is going to say, yeah, my service sold $10,000 worth of business, but the cash didn't come until January. So she recognizes that she has a sale of 10 grand, but the cash flow doesn't come till January. The accrual of the basis of recognizing cash in the month that it actually occurred is accrual based accounting. So I don't want to get too, so it's recognizing when it happens. That's considered accrual based accounting. And then cash flow is when it actually hits the bank. Hope that answered that question. And then the other one was the question about loans received and loans payment. Loans payment, the loan payment is going to be under the investment section of the business. It will be under the investment part of the payment of the loan. And I think I have an example. I have an example in a minute. So what counts as cash going out? Expenses of payments, rents and utilities, payroll and contractors payments, supplies and inventory purchase, loan repayments or outflows, equipment purchases, and marketing and subscriptions. So here we go, right here. So these are kind of the cash flow statement sections. So for example, operating types of activity, operating expenses will be the day-to-day, it will be your sales, it will be your rent, it will be your payroll. Investing would be your investing activities, will be buying or selling big stuff like equipment and vehicles. Your financing activities will be the borrowing or repayment of the loans, the grants that you receive, or any owner deposits that you have. So those are how it's broken down. So actually borrowing, paying a loan will be more of a financing activity versus operations. So you think operating day-to-day, think investing, purchasing, buying equipment, selling assets. That's kind of your investing. And then financing activities is the borrowing and repayment and having people or loans, borrowing and grants and things like that coming into your business. Any questions? I hope that answered. Okay. So let's do a real life example of Lisa's coffee shop. So she sold coffee and pastries, and the cash movement was $10,000. So that's a movement up of $10,000 operating inflow. She paid rent for the shop, operating outflow. She bought a new espresso machine, investing outflow, $2,000. She received a small business loan, that's financing, $5,000, and she won a pitch contest, and that's also another $2,000 income. So, any type of reflection, what's one of the surprises you had about your business when it comes to your finances? Any?
I think a lot don't realize business can be seasonal.
Yes.
And those sales, many times they put a constant number across, but in real life, that's not how it works.
Right. Yeah, and that's why the cash flow statement is always so helpful, because it's also when you prepare, it's also timing. So for example, if let's say your insurance is something that you pay all at once, right? So I work for, I'm also I do accounting for certain people. So it kind of helps me stay relevant and all that. So I do accounting. So for example, we just paid the general liability for a nonprofit that I'm working for as a treasurer. And we paid it all in 1 month, right? But we built that into our cash flow statement and our forecasting that we're gonna pay this in January. Right? So we knew that $4,000 was going to hit our account in January, and we were able to budget for that. Be able to budget for that, and we knew we had the money in the bank to pay for it. What if we didn't say, okay, yeah, we budgeted $4,000 for our insurance, and we're going to pay it over time? That's not actually how the cash flow went through, right? So you want to be able to match it with those big expenses. And we'll kind of talk a little bit more about how to kind of manage your cash inflows and outflows, and what are kind of some of the pitfalls, what do we see, and how to kind of go from there. Any questions?
So online,
Yes.
Michelle said, surprises, delaying payments from insurance and red tape to collect on services provided.
Yes, definitely. And it's all about the timing, right? And so sometimes, and we'll talk about a little bit in here in this presentation, also talks about some of the pitfalls, like, for example, if you have expenses coming up, but you're not making that revenue right then and there. Prime example of the insurance payment. So if we know that the insurance payment is due in January, we need to make sure that we have enough revenue to cover it in that month, right? So we're gonna make sure that whatever we need to do, at least we're making that revenue to be able to cover the insurance, right? Whatever we need to do in that case. So we should have a good December to be able to make sure that in January, when we have big payments coming through, we'll be able to cover it. And also it's kind of also a planning tool as well when you look at your cash flow statement. If you know you want to buy or purchase something larger, then you're going to purchase it when you're making that cash, when in those months where you are generating more money. For example, I'll pick on my sister. She does most of her Christmas time is really big for her. That is kind of when she's always doing the Christmas parties, things like that. Maybe not so much summer months because they're on vacation, they're not partying, they're not having things like those types of events, graduations, all those type of weddings. So summer months may be, March or May and things like that may be good months for her. December, we know it's good. January, February, not so much. Those because people are no longer, they're recovering from their parties. People are starting to get back into business. And so she has to be able to figure out when she could pay certain things or purchase certain things and things like that. I'll give you I pick on her a lot. So if you ever meet her, don't tell her.
Donna, along those same lines, online, someone said slow payment from clients, like they are on a net 45, net 90 payments.
Yes. And so you always need to watch so even though you have, and we'll talk about this, and it's kind of in the presentation as well. When you have clients, like, for example, who are like slow pay, what do? You have to, those letters, those invoice needs to go out, those reminders need to go out, and having those prompts to say, okay, having systems in place, like an accounting system, a billing system that will alert them that, okay, your payment is overdue, and really, really trying to get those collections, because your income statement is going to tell you, yeah, I made that, like I said, the income statement is going to tell you, yeah, I made that $10,000 sale, but your cash is going to tell you I didn't collect it. Right. And so that's where the difference lies. Okay, so common issues. Right, here we go. Sales are up and no cash. Invoices are being paid on time. So you want to be able to track your receivables and follow up quickly. So these are kind of some common cash flow issues and how to spot them early. Big time purchases can drain your bank account. For example, my sister called me the other day. By the way, I'm not her accountant.
So there's no.
Let's just say that. Disclaimer, I'm not her accountant. She called me, she's like, Donna, guess what? And she's been wanting to buy a van. So 4 years, for the last 5 years, this lady has been renting she's a caterer. Last 5 or 6 years, she's been renting a van. Like from like a rental place, right? And I'm like, why do you keep renting a van? Why don't you get the van? That's a business expense, right? So he's like, Donna, guess what? I was like, what? She's like, guess what I did? Got the van. I was like, oh, that's great. And she's like, yeah, and I paid cash for it. I said, you paid $35,000 for it, or you paid $35,000 for a van all at once. And I was like, who told you to do that? She's like, I thought I had the money in the bank. Okay, so big one-time purchases may drain your cash. So sudden bank balances drop, and then you need to plan ahead. Or she could have leased it, or she could have paid on time and kept some cash in the bank. Spending too much too soon. Expenses rising faster than your revenue, so make sure you prioritize driving expenses and grow slowly. People want to grow a lot quicker. They're like, everybody tells you, grow, grow, grow. You got to expand your business, grow, grow, grow. but you don't always have to grow that quickly. You know what I mean? You could be steady profit, kind of like the turtle, the hare and the tortoise. Steady growth you'll be profitable, because that's what we want to do, is be profitable. But you don't want to you want to not spend too much too soon. It's a story that I actually did when I started Paget Business Services. One of the things back in the day, this was like early, I like 1999, I left corporate and was like, I'm gonna start my own business. I love accounting, yeah. And so I'm gonna purchase accounting franchise, work with these small business owners. They had 25 or less employees. It was great. I love the consulting part of being able to help them grow their business, not necessarily doing the accounting. However, one of the market, and it was a franchise, so all I had to do, which I love franchises, by the way, it's a whole nother story. But one of the things I had to do was just follow the marketing plan. And part of the marketing plan was sending out letters to we snail mailed it back in the day. It wasn't email and things like that. So I had to mail these marketing materials to people who were in the area, who had businesses. So what I did was, I was like, well, I need to make copies of all this stuff and email them. So I'm gonna buy a copier. I had 2 clients at the time, and I bought a $5,000 copier. So here is spending too much too soon. I didn't need a $5,000 copier. It just made my life easier. And it wasn't like the little copiers you get. It was like, when you work in like a major corporation, it's like that big copier that does all the stuff and it emails, and it didn't do that at that time. But it was just like that big old copier sitting in my office that was probably biggest, maybe not even big as this whole entire space that I wind up purchasing, just because I was like, okay, I need it to be able to send out this information. Did it work? Yeah. But what I should have done was got someplace and made some copies and sent out the things that I needed to send out, and kept that money. So prioritizing profit driven expenses as well. I could have spent more money on buying more marketing materials, right? Because that's gonna drive sales versus actually buying a copier. So I have to be able to do it. So those are some of the common cash issues that people have. And then I was popping early. Review your cash flow all the time. Review your cash flow weekly. Review what's in your bank account. Use a 90-day forecasting. There are so many systems that are out there. QuickBooks, Wave, they will have those systems in place for you to be able to review what's coming in. And you can spot it early. You'll spot early, right? Watch for cash gaps, expenses due before income arrives. So for example, you can go in and say, okay, you can even maybe talk to your vendors and say, hey, let's move the payment to 30, 60, let me do 90 before, because I know that there's income coming through. For example, like we said, your receivables. We know if you're giving them, like the person online was saying, that my receivables are 40, 30, 60 days out, but the expenses don't stop, right? You still have to have your rent. Your rent is going to be, if you actually have a brick and mortar business, your rent's going to be due whether you make a sale or not, right? So you got to be able to say, watch for those incomes, those gaps before they arrive. And then some good habits. Okay, so why does review your cash flow weekly? Why does that matter? Catching issues early, like slow payments, unexpected expenses, that'll help you take action before cash runs out. Set a weekly reminder to do a bank review, bank balances, look at your bank balance, any incoming payments, upcoming payments, and just use a dashboard or just a simple spreadsheet to update it. But set a weekly reminder to do that. So that would be a good habit to just be like, okay, on Fridays at 10 o'clock, I'm gonna upload all my expenses so I can know where I am. And then also good habit I've seen before is definitely separate your personal and your personal from your business finances. Mixing the accounting is not good. Mixing your accounts make it so hard to track what's really for your business or what's really for your personal. And you want to use a separate business account. And how you do that, you could pay yourself by transferring money into your personal account as an owner's draw. Or you could put yourself on payroll and you could be and take a salary. So those are the two things. Definitely separate your business. And don't, we have so many different cards in our account, in our pocket. Just make sure you're swiping the right one. Swipe the business card for business expense. Swipe that personal one for your personal needs. There are times when, even I had to like, oh, dang it, I left my bank card, my business card. Let me just use my personal one for this business expense. I need some ink. Okay, ink, yeah, I work from home. It could be for both. If it is a business expense, use that business card, right? If it's a personal expense, we're not going to Macy's because we have money in our business account to get a purse and call it a bag that we need for business, right? So let's just make sure that we keep business and personal separate. Yes.
So definitely understand the point of never, ever, ever using the business card to buy the Coach purse for sure. Like, but if I do, buy, I'm at Costco and I buy my big bulk thing of Topo Chico on my card, can I not pay myself, can my business not buy it from me?
Yes, but it also is a little, so
Is it
Yes.
just cumbersome?
it's just encumbersome. Yes.
So it's not like a problem other than just the accounting.
It is because also it is. That's more legal. It is because it depends on how your business is structured. So for example, if your business is structured as a corporation or LLC and you're mixing business with your personal, then the people, IRS, or even people who are like your liability is kind of purged. They call it, it kind of gets purged and gets murky because they don't know if it's you the business or you the personal when you start mixing those expenses together. And they may see you as one and the same. And then your liability kind of is a little bit it may become a problem as you're mixing these expenses together.
So this is probably jumping ahead and applicable to nobody in this room, but if I have purchased copious boxes of Topo Chico with my personal account, and then mix those funds apparently. It's really important for me to have the protection of my LLC, right? Like that's really critically important to me to preserve. If that has been compromised, should I just go ahead and shut that down and start a new LLC
no.
to start?
No,
start
No,
from scratch?
not for Topo Chico. But like I would say, no, I think you just need to moving forward, just don't, just kind of don't mix it. But I think the bigger thing is don't make it a habit don't make it a habit because they're not going to be able to, if something happens and they're looking at your finances and they're seeing a lot of personal versus business stuff mixed in, then they're like, this person is one and the same and not operating the business properly. So just don't make it a habit of doing it. One or two incidents, yes, but not a habit. All right,
Thanks.
no problem. And then, okay, so good flash flow, build and maintain reserves. This is really, really key. So like cash reserves acts like a shop. It observes and it helps with emergency funds. Like personally, most people, we have like emergency funds, right? In business, we call it reserves. It's the same thing. Having an emergency fund for your personal, having a reserves, cash flow reserves for unexpected costs. As a brick and mortar business, and if anything goes wrong, you probably have to fix it. So knowing that you may have to, the toilet goes up, the AC goes out, and that's something expensive you have to fix. If you had cash reserves, emergency fund cash reserves, you'll be able to do that. Also, when you're looking at a loan or even getting a loan or a lender, they want to at least see that you have some type of reserve in the bank. People say you don't really need to get a loan until you need to get a loan before you need it, technically. So having that reserves that shows that you're able to save money you have a little bit of a reserve in the bank, you get a loan for like, I need major purchase like equipment, I need to get a loan for that, or something bigger that I want to expand the business, so I'm getting a loan. But I do have cash reserves in the bank. I have about $10,000 or $5,000 in the bank, but I need 50. So this is where it's showing great habits. So here's some accounting tools or recommendations that I have for you. Wave accounting is free. And QuickBooks Simple Start, that's a great way for tracking things. Float app. This one I looked at that one. It's a great forecasting tool if you need it. And then also Google Sheets, Excel spreadsheet, just the basic way to do it yourself and track your cash flow. And then books. Profit First, this is a really good book. I'm listening to it now. It teaches you cash flow systems that prioritize cash for profits. And then Simple Numbers, Street Talk Big Business by Greg Captree is a great book as well. Any questions?
You will get the slides.
Thank you. Okay, so.
Hang on.
Oh, I'm sorry.
It's online and in person.
Sorry, yeah.
Hi, we do have a question online about, can a small business set a fiscal year? Their business is very much like your sister's in that it gets busy in October. So can small businesses change their fiscal year?
They can change your fiscal year. It just depends, and especially if they're a full-based accounting system, they can change their fiscal year. Most businesses are on a December 31st business. That's kind of normal. But most business, they can actually change their fiscal year. The tax purposes is really where you kind of it may be a little bit tricky just because taxes are just annual, and being able to kind of coordinate that, but you can track, change your fiscal year. You don't necessarily, you just really need to understand where your cash flow is going. Like you really need to know, like if October is your best year, then really kind of focus on that and do a forecast rather versus changing your accounting year.
Perfect. Okay, now a question from in here.
So, the whole idea of paying ourselves, right? Like, how does that work into the accounting system? I know it's like, people in my industry in photography, we are really, really guilty of, just considering the only expenses are the gear we spend and maybe the rent, and we don't end up, accounting for ourselves. How does, I saw you had payroll in there, but how do you account for what you're paying yourselves in this? And I'm also a big Profit First fan, huge, I did change my life. Profit First is the way, yeah.
So a couple of things you could do, 2 ways. You can actually put yourself on payroll and become an employee of your company. And so you can use any type of payroll system, things like that. Or you can do an owner's draw. So you could say owner's draw, meaning that I'm gonna take a certain amount every month out of my business for myself. And you could do it simple payroll business a transfer from your personal to your business. So $2,500 every month, that's what my expenses are gonna be. I'm gonna take a draw and pay myself $2,500 a month every month and do an automatic transfer. Or I am an employee of my business and I will be able to put myself on payroll and then pay myself through those 2 ways.
Right. Okay, is there another online question?
Not at this time, Tracy.
Okay. In here. Are grants and pitch, is that considered income?
No. Okay, thank you. So grants and pitch is not considered income. Here's the deal, y'all. There are so many people out there, and this is kind of a little bit of, I've worked with so many business owners in the ecosystem and different programs. And one of the things they've done is they've made a business out of pitching. So they will go, I had a client, she is great at pitching her business. She does have a great business, but she's also really good at pitching. And so I think she raised about $75,000 through pitching her business. But that's not income. That's investment, right? When she went to get a loan from a bank, they're like, yeah, we can't count that as revenue because you didn't earn it. It's not earned revenue. It's through pitching. So therefore, she wasn't able to account for that revenue as making her business profitable. She wasn't making a lot of money in her business because she was so much focused on her pitching and getting money through there, where her business didn't look, her income statement didn't look good because it wasn't built, it wasn't showing that she was making money. Does that make sense?
All right, anything else online?
Yes, for quarterly taxes, is it true that Q2 is only April and May?
I didn't hear that.
For quarterly taxes, is it true Q2 is only April and May?
No, no. So you have, your first quarter is broken down January, February, March, April, May, June, right? That's Q2, consider Q2.
All
We
right,
have another online if you don't have one in the room, Tracy.
yeah, you're good to go.
Please explain, and it's in quotes, payroll, because self-employed people cannot be on payroll and get a W-2 unless their business is an S corp. I think that's part question, part statement.
Yes, yes. So if the business is a S corp, they can get a W-2. Other than that, they would, for tax purposes, they will have to become self-employed. Here's the thing about, it's kind of I would say, kind of tax management or tax kind of managing your taxes. If you want to be if you're self-employed, that's fine. Here's the thing, tax liability wise. Once you're self-employed and you file a Schedule C and things like that, most business owners are really shocked at the end because they actually have a huge tax liability. Because here's the deal, the Social Security and Medicare, you have to pay that, and you have to pay both parts. So once you're making a profit, you're paying taxes on the profit, but you also have to pay the Social Security and Medicare, and you're paying both parts. So that becomes a huge liability from tax purposes. If you were a S corp and you became an employee of your company, then each quarter you're paying that. Each quarter you're paying in, and so it's not such a huge, it's still the same amount, it's still the same amount. It's kind of when it's paid and how it's paid. So your company is paying your portion as an employee, they're also withholding that portion from your check. So it is going out, but it's going out quarterly, not waiting till the end of the year. And that's what a lot of self-employed people do, is they wait till the end of the year to pay their taxes, and they have this huge liability. Or you could make quarterly tax payments as well to eliminate that huge liability. But they're still shocked because of the amount that they have to pay, because they don't really kind of take into account the Social Security and Medicare taxes that they have.
Okay, great. Any questions in here? All right, well, we have your contact information, how they can reach you. If there are any questions, feel free to reach out to Donna later. Thank you, Donna, thank you. Thank you all for being here today. Online, we've got a little something for you. Thank you so much for being here.
Thank you.
All right, so thank you, Donna.
Yeah. If you guys have any questions, just don't feel free to contact me. You have my contact information. You'll get the slides. I love doing this. The time went by so fast.
I know it does. It does. Once you're up here, for sure.
Oh, I didn't think I was gonna take that long. I
Yeah.
thought it was gonna be shorter.
Well, it just sometimes comes up on you as you get into it. So thank you, everyone. We're going to say goodbye to our online attendees.
Bye, everyone. Thank you.
Not fully sure what happened. We lost a whole lot of people all of a sudden. I think when she said goodbye, I all thought we were leaving. So we'll have, I'm gonna post the poll real quick because it will help us know what topics you want in the future. And it will also help our speakers to know, if what you liked and what you didn't like and what they would improve or what they need to add. And it's also nice to get this grand kudos. Are you guys seeing the poll?
Yeah, we can see it, Kimberly. Thanks.
And then we will do one short round after the poll is finished of networking. Couple of things I wanted to highlight while you guys are working on the poll. Watch your email for our 10th anniversary in July. A reminder that our rural grant is currently open. And we are giving 10 of those. So, it's always nice when you're not competing with 200 other people for one grant. Not saying you would be competing with 200. I'm just, our accelerator season is in pause right now for the summer, but it will kick back up before we know it with Houston application opening in August. So that's earlier than normal. So again, keep an eye on your email if you're in the Houston zone. And it looks like, where are we at on the phone?
Kimberly, I have a question.
Yeah,
I applied for a vendor for that event in July, the anniversary, the celebration.
yes,
Yes. When will we be notified whether we're accepted?
that's a very good question. I know that Tracy is working on those applications right now.
Okay.
When will you share your email with me and I will follow up and I'll email you back.
Okay, for sure. Thank you.
Question about online offers. Yes, online accelerators. Thank you, Michelle, for asking. We will be opening applications. We just finished an online. Those will generally run in, so the next one will run in 2026. However, although not confirmed, I'm working on an online rural. Some of you are in rural because I actually know you and I know where you're at. Doing one specifically for rural-based businesses and making that virtual because obviously very hard for rural-based businesses to all meet in one central location. So thank you for asking. Okay, so I'm gonna set up another round of breakouts for you guys to share what you can, what your business is, what you do. It'll be a shorter round, and then we'll be done for the day. I thank you all. I love our virtual room. I love the community we've built here. I'm dropping my email in the chat if there's anything you need from me. Please feel free to email me anytime. And Gwen, don't forget to send me your email. Actually, I have your email from where you registered. Never mind. I wrote your name down. I've got your email. Okay, let's see here. You should be invited to the breakout rooms. If you end up in a room by yourself, I will move you to a room with people.
Do we end recording, Kimberly? Or
Huh?
do we end recording or we keep that on?
Oh, yeah, we couldn't have done that.